today's webinar hosted by the Forward Consulting Collective. And it's great to see you joining this event, of course. At Forward, our consulting work focuses on accelerating growth for climate-first companies and change makers, whether it's helping startups refine their go-to-market strategy, supporting corporates on ESG roadmaps, or enabling NGOs to scale local impact. Our goal is to turn plans into real measurable progress. Today's session, Financial Models for Startups That Can Scale, digs into one of the biggest blind spots for many climate venture, the financial models that underpin sustainable growth. So we are very pleased to be joined by two of our consulting collective partners, which are Marina, if I can pronounce your name correctly, is Skorulskaja. She's founder and CEO of Green Vision Strategies, who specializes in regenerative businesses, solutions, and capital acquisition. And Soren Gade, founder of Gade Growth CFO Solutions, who brings deep experience in financial leadership and scaling strategies for SMEs. So I think I can leave the floor to Marina, and I see you soon.
Yeah. Thanks a lot, Chiara, for introduction, and thanks also, Soren, for joining kind of on the last minute. And I just kind of hope that our, collective intelligence will make it even more engaging with kind of insights maybe and questions from your side as well. So yeah, Chiara kind of introduced me, and my company specializes in boutique consulting for sustainable and regenerative companies, primarily in financial endeavors. So I know it's a late evening. Without further ado, I'm just jumping straight into agenda, and I basically split it in 3 parts. We will start on talking how to build credible financial models, and I will also have prepared you a very detailed and step-by-step guide how to do that. In second part, I will show how to integrate the fundraising milestones into your financial forecasting. And lastly, the dessert of today's presentation are the metrics that investors really want to see. And at the end, hopefully, we will have questions for some Q&A as well. So before I start, you can drop in your questions during the presentation as well. I think we might pick up several questions during the presentation as well. All right, so let's kick off with some basics. How do we actually build a credible financial model? I know this from the experience that many startups hit a wall there, and I understand it. It's easy to think that this is all about being a spreadsheet geek or nailing a complex math, but in reality, it's not a math competition. It's about building a model that makes sense, that is easy to understand, and that actually supports your story that you're telling about your business. So maybe you can, to imagine it, start thinking of it like this. If your financial model was dropped into investors' inbox without you there to explain it, would it speak for itself, or would it build confidence, or rather cause the confusion? So in the next few slides, I'll walk you through how to build a model that you can confidently present, that investors can trust, that actually helps you to make better decisions. So in simple terms, financial model is a tool that turns your strategy, assumptions, and operations into one forecast that helps you test different assumptions and scenarios that help you to make better decisions and communicate your plans, not just to investors, but as well to your team and other stakeholders. It is actually the most important decision-making tool nowadays that helps you to test the viability and resilience of your business. It also provides you direction on hiring, when to hire, how many people to hire, on your expansion plans, and not to forget the pricing strategies. So the key questions we answer when we build financial models, for example, the ones that come to my mind, are when can we break even, or can we even break even, and how long the cash will last, or what happens if we grow faster or slower than anticipated. What you're seeing here are 3 core components of a robust financial model. Profit and loss statement that shows your performance. Cash flow statement shows the liquidity. And the balance sheet shows your financial position at a specific point in time. So as I said already, the clearly modeled spreadsheet tells a story of the business and showcases what are the assumptions, how do we plan to scale, and what resources do we need for that scaling, and what our success or failure look under different scenarios. I know this slide is heavy, and I know it's after 7 p.m. in the evening, so bear with me. But I actually built this so you can look at it, kind of go later back to it and check in more detail when you have a minute. So Chiara, are we sharing the slides later on, right? Chiara, are you there?
Yes, slides can be shared at the end so that people can revise them.
Okay, perfect. So, just for you to know that I'm not a fan of slides like these, but for the sake of your learning kind of and getting as much as possible from that, I just, brought everything into one single slide. So these 3 core statements that I mentioned before, they require specific and kind of interlinked sequence that we can ensure the accuracy, coherence of the whole story. So to build a robust financial model, what we have to do, we have to start with assumptions. And how do we build credible assumptions? Well, by conducting market research and talking to people, your suppliers, customers, employees, advisors, you name it. And then we translate those insights into assumptions that reflect the real world and market situation. So the simple rule of thumb you could follow is the one that I follow more or less, is 50% of the time you spend on the market research and communication with the stakeholders, and the other 50% on actually building a spreadsheet. And best practice advice, build assumptions tab where all your drivers like sales, growth rate, margins, payroll headcount are clearly listed and labeled. And my advice is to never actually hard code numbers into the statements themselves. So separate the assumptions from the formulas and the logic and the outcomes.
Marina, may I ask you one question here? So when you are building your assumptions, because we are talking about climate businesses, what are you thinking when kind of, you have to model a specific business. Do we need a specific set of drivers that relates to this, or how do you see that?
Yeah, that's a very good question. So, of course, there are some drivers that would be probably applicable to all of the businesses, like payroll headcount, right, or the um, margin targets or inflation, you name it. However, of course, there are industry specifics and maybe not even industry specifics, but it would depend whether you are a product company or you are a service company, and which kind of products exactly you are building. And maybe something else that I have not mentioned here is the kind of impact targets as well. We should kind of have assumptions on that, how much of the CO2 is avoided or reduced, for example, right? Of course, these nature-based, nature-specific assumptions could be maybe a little bit even more difficult to forecast, but that's why they are called assumptions. Would you add anything to that, Soren?
I think that makes sense. If we think about it, all of our businesses are slightly different. So that means that we have to try to consider, how do we best model our business? Because as you mentioned in the beginning, Marina, it's all about telling the story. We want to tell a story with our model. And that's why, for, let's say, a company that is building out solar parks, they might talk about, okay, how many megawatt are we producing, or such things over the 5 to 10 year period.
Exactly. So in this case that you have mentioned, so probably the assumptions also could be for example, if your product or solution requires for your ideal customer to kind of completely change their processes, and then your assumption is that let's say your customer adoption rate is 50%, probably that's not the right assumption. So it has to be grounded in reality as well. And I do agree, it can be very business and sector kind of specific, and even niche specific, kind of matching the exact niche that you're serving. So maybe the participants have particular questions on their particular businesses, so we could pick up and discuss that as well.
Thank you, Marina.
Yeah, thanks a lot, Soren. So we're done with assumptions. What do we do next? Then we build the core statements, the core pro forma financial statements. And we start with projecting revenue and expenses. The critical output of that profit or loss statement would be the net income. And why is critical, you will see later, because we're going to use it for cash flow statement and projecting your working capital needs and equity financing as well. So building a cash flow statement, we start with a net income from P&L. Then we adjust for non-cash items like depreciation, amortization, etc., and also changes to the working capital, as I mentioned. And this calculation determines what is our ending cash balance at the end of the year. And have that in mind, because this we are going to use for the balance sheet that is the last from these three financial statements. And actually what is the balance sheet? It is kind of a final check whether your assets equals liabilities plus equity, the fundamental accounting equation. I think Soren could echo on that. That kind of, it's, you start with the assumptions and you finish with the checking whether that accounting equation balances. So how do we do that? So we take cash from cash flow statement and retain earnings from P&L, net income, and link them. The next step would be to test and analyze, because often, you do your best, but then at the end, the balance sheet is not balanced. So what do you do then? You check on potential kind of areas where your model is broken. And you trace links, you double check the assumptions. From my experience, mostly it is the problem with the cash calculations and retained earning connection as well. And maybe if you have debt financing, this is another kind of point that makes the calculation and matching kind of a little bit more difficult. But we will get to that later as well. So to really stress test what we do, last would be the scenario analysis. It demonstrates that the business model is robust or not, and kind of prepares you for a scrutiny from the investor side. So maybe I just actually remember something. I often get a question, the worst case scenario, how really bad it should be. So of course we don't forecast, the end of the world or the something like that. But the best case and worst case should differ significantly, because if it's just like 5% difference in revenue between these two, or cost, then it doesn't really make sense. Or if you can really back that up with your data, then of course this is your kind of free to do that as well. All right, so here we come to the most common mistakes. Many of the pro forma statements that I see, they are slightly messy and hard to follow, maybe except for the person who built them, but even that is not always the case. In a strong and credible model, every number should be easy to understand, because it is backed by clear assumptions. And my advice, if you cannot explain a number, you probably shouldn't include it in your statement. So let's unpack some of the most critical mistakes that entrepreneurs make in financial modeling. So the most often I come across is the lack of assumptions page. So to me, this is like asking someone to bake a cake without telling the ingredients and expecting that the cake to be perfect. Investors cannot evaluate the logic if they don't know what is it based on. For example, if let's say your revenue is growing five times year over year, they'll want to see what assumptions are driving that, whether it's price, volume, conversion rates, etc. Hard coding numbers directly into the formulas. I actually said I'd never do it. So you can do it, but that's, it can be, it might seem easy and convenient, but then after some months or some weeks, then you try to change something and then suddenly the model breaks, or worse, it seems that it works fine. However, it gives the wrong answer without anyone noticing. So circular references and broken links, they occur when two variables are interdependent. For example, interest expense depends on debt and then depends on interest. This is sort of a infinite loop. So this kind of circular logic can create endless calculation loops and produce the errors that are really hard to spot. So to fix these circular references and break the loop, we can enable iterative calculation in the spreadsheet statics. And this is a kind of a special, how do I put that? Special function maybe in the Excel that kind of helps you to do that. And we could, do a 1 hour course just about that. So I'll maybe stop here. Another mistake that I come across often is when inputs and outputs are mixed. So you remember assumptions are inputs and all the calculations are outputs. And ideally when models are modular, and if you're building calculations directly inside your income statement, it becomes, very, very difficult to audit and update. So a clean, good model keeps input logic and outputs on separate sheets or at least clearly separated sections, so it's easy to trace and adjust when we need it. And the last is lack of scenario planning. If your model only has a single forecast, you're not showing the full picture. So what if sales are lower 20% than expected? What if costs are double? Or, something more critical like fundraising milestones delayed. So scenario planning in general, it shows that you are prepared for uncertainty and thinking about it and thinking ahead, and that you can lead your business forward. So to summarize, maybe I'll put it this way, that everyone is making mistakes, but in financial modeling, some mistakes can come with a very serious price tag. Some errors might seem minor, but it can lead to lost investor confidence, delayed funding rounds, and ultimately cash flow crunch that puts your entire venture at risk. So yes, we all may make mistakes, but some are just very expensive to afford. Chiara, are there maybe any burning questions in the chat so far?
Not yet, but maybe I have one. Both of you, I'm asking both of you, in your opinion, so based on your experience, why do models lack of assumptions page, for example? Is it linked to any particular reason, lack of knowledge or experience? This is something that I'm asking myself right now.
So from my experience, I think that it's not easy to build assumptions, because you need to do a market research for that. You need to talk to people. You cannot just assume things yourself, right? And that takes time. And know how things in the startup kind of environment happen. Everything is fast. You need to do things fast, and you don't really have enough time to kind of sit and do market research and talk to people and kind of, take it from there. So maybe that's my perspective.
And I'd like to add a tip that Rebecca is giving in the chat, and that is for inputs, for instance, it's a good idea to actually give the inputs a different color, so it's very clear what is an input number and what is a calculated number. So thank you very much for that, Rebecca.
Yeah, exactly. This is the practice that I follow most of the time, I must say. Not always.
Just to read the question that Rebecca asks, because of I don't think the recording will show the comment sections as well.
Sorry. Okay.
No, the mine. So Rebecca is saying that a good tip for keeping inputs and outputs separated is to use a different color, font and color in the spreadsheet for hard-coded inputs number and calculated numbers. So maybe blue for the first and black for the second one. Thank you. Marina, leave to you.
Yeah, that is spot on. That's a spot on advice. So now that we have covered the basics on building a solid model, let's talk about how we can connect it to our fundraising strategy. Because, the model is not just for tracking the performance, it should also help in first place, actually, you, the entrepreneur, to plan how much capital you need, when you'll need it, and what you're going to use it for. So in this section, we will look at how to actually build fundraising into your forecast so it supports the decisions and gives the investors confidence in your funding plan. So this is your investor-ready fundraising cheat sheet that I have prepared this morning. Really high-level checklist. However, it kind of helps you make sure that your model covers all essentials before you go to raise capital. So the executive summary, very important. So the first page or the first sheet of your spreadsheet should always be the executive summary, which is kind of another tip from my side, should be designed in a way that is ready to be printed, and kind of it is, ready to be used in that printable format as digital as well. So an executive summary, you usually include some visuals. I'm a fan of charts, and most of the important metrics you'd like to showcase there, like revenue, maybe growth rate or EBITDA. So assumption sheet, it's actually, the brain of your model. It's like we have discussed, it is slightly sector specific. However, it should include pricing assumptions, cost assumptions, headcount, plans, taxes, especially relevant if you're selling to several countries or multiple countries, and anything actually else that significantly drives and influences the numbers. And all inputs should be clearly labeled, as someone mentioned, and ideally backed by sources, whether that's market research or some internal data. So then we have a scenario page that allows to test different market conditions and sales forecast. As I mentioned before, this is very important for resilience planning and credibility in front of investors. And finally, everything feeds into the core model, where you calculate your revenues, expenses, and produce fully linked financial statements, the income statement, the cash flow statement, and the balance sheet. So when you have all these elements in place, you will have a model that tells a confident story to investors. And actually, what I often get asked, so when do we really need it? At what stage of the venture? And maybe if you are doing angel round, or your family and friends invest, maybe you're not in the need of very sophisticated financial model. However, when you are going to professional investor to institutional investor. So all that should be ready. So cash flow often matters more than profitability, especially for early stage startups, because cash flow, it shows the real money that you have in your bank to pay suppliers, staff, and to cover your ongoing expenses. So, as you probably are aware, you can show a very healthy profit on paper, but still run out of cash if receivables are delayed or some capital investments pile up. And this is especially valid for the deep tech, hardware, climate tech businesses that need to hold, for example, inventory and have a high capital expenditure. So this formula that you see here, it helps you to calculate the funding gap, the actual equity funding that you are needing to calculate. They require equity. You need to take ending cash from your cash flow statement, subtract the beginning cash, operating cash flow, investing cash flow, and debt financing, if any. So in simple words, how much cash you want to the end of the year minus what you already have, minus the cash you generate or burn from operations and investment, and minus any new debt you plan to raise, if any. And the result is the equity capital you need to keep your business running and growing without running out of cash.
And may I ask a question here? Because if we think about we said in the beginning, our financial plan should be 5 to 10 years long. I guess this is when we are over the first stages. Now, what would you recommend in terms of frequency of fundraising? Because I guess we shouldn't raise for 10 years today. Or what is your take on that?
Could you maybe elaborate a little bit? Question. You meant the.
So what I meant was, say we have done our financial plan, we have calculated now how much equity do we need, so how much capital do we need from an investor, and we basically want to take how much do we required equity we're talking about here. Is it for our entire plan? Is it for maybe just a period of time of the plan, or how do you see that?
So ideally, because of the cost of cash, basically you don't want to, actually no investor will kind of provide you the cash that will just sit in your bank account for 2 years without being spent because of the high cost of, because of basically of the cost of capital. But on the other hand, fundraising is a second full-time job, as I hear from the founders often. So you cannot basically do that every 6 months, right? So I think it should also match with your kind of milestones that you are planning. For example, you want to build a pilot or a prototype or kind of a go-to-market into your kind of go-to-market in your, for example, first country that you're wanting to sell. So, and then expansion. So ideally, you are tying it to the milestones that you want to achieve within those kind of a few years that you're fundraising. So from my experience, like annually is kind of that between 1 and 2 years. This is this delicate balance that unfortunately, yes, you do need to do that again and again, because nobody's just going to hand over you the money to store it in your account for several years without being kind of invested somewhere else. So is that what you meant, Soren?
That's exactly what I meant, because I think it's right here. You say we have the required equity. So we have already an idea about, with this amount, how much we are raising, right? And with that, at the same time, we have probably a valuation of our company. So we get a price for this equity. That is how much we have to give away to an investor.
Exactly. So the earlier you fundraised higher amount, the lower valuation you get. So because valuation grows with your achievement of your milestones.
So you're right. It is really critical to know how much you need to raise.
How much and when.
Yes, exactly.
Exactly. Yeah. Very good input. So the last part of the presentation, I hope the audience still has some capacity for some more insights. So I want to give a brief summary on what are the most critical metrics that investors want to see. So investors, they want to also know how efficiently and of course how realistically you grow. You start with a simple metrics like burn rate and runway. I'm sure that most of the audience are aware of about those metrics that show how fast you're spending and how long you last before needing more capital. Of course, margins, they matter because they show whether your business can eventually become profitable. For an early stage company, you should probably first focus on the gross margin and EBITDA to prove that the operational kind of engine works. And as the company matures and grows, the focus ideally should shift to the net income and free cash flow to reflect the sustainable financial returns. So next we have the customer acquisition cost and lifetime value. Those metrics are critical when you are trying to understand the customer profitability, and investors want to see that you are not just acquiring users, but doing it cost efficiently as well. And finally, one of the most overlooked, from my experience, is unit economics. I've come some startups, especially in climate tech or deep tech, who say, oh no, we're not a SaaS company. This doesn't really apply to us. But the truth is, it applies to everyone, whether you're building hardware, software, product, or service. If you can show that each customer or sale brings in more value than it costs. So one product, one service, one customer. More value than it costs, kind of, to acquire and deliver. That's when actually you know that your business is scalable. So knowing these metrics and showing how they improve over time, because you might start with a very poor unit economics at your ideation stage or prototype stage. However, it should improve ideally over time. So knowing those metrics and kind of working towards improving them builds also trust and shows that you understand your business at the level that investors expect. And this brings us to the
Sorry, Marina.
Yeah.
If I Rosa asked a question in the chat and is related to the burn rate. So maybe we can go back to the previous slide. She asks, if you are a pre-revenue, how would the burn rate apply to a pre-seed fundraising round?
So you are pre-revenue, however, you are kind of funded somehow, right? Either you're bootstrapped or kind of you are someone is funding you because you have basically some costs, so somebody is paying those costs, right? So the burn rate is how much money you spend per month. If that is only, if you're building, for example, some software business, that could be very low, right? However, if, for example, 3 engineers working on that and not paying themselves a salary, so you can count it kind of in 2 different ways, whether you're counting those unpaid salaries or not. So it maybe depends on kind of your strategy and approach. Does that answer the question? I hope so.
Thank you, Marina. In case Rosa has other questions, she will write it again. Thank you.
Yeah, thanks a lot. And yeah, actually, we are at the end of the presentation, and I would like to conclude it by saying that modeling finances, it's not just about spreadsheets. It's a beautiful, amazing tool that helps you think strategically, challenge assumptions, and eventually make better decisions. The ones that master this, they are not just managing numbers. They are bringing some structure to the chaos. They are asking sharper questions and help their whole teams to see the path forward. And if you can confidentially explain your model to investor, you're stepping into the leadership. You're clearly showing that you are capable to lead this business. So, yeah, maybe I'll conclude here, or yeah, I lost my thought. Sorry, I wanted to say another sentence, but then I just lost my thought.
Don't mind.
So yeah, actually welcome any questions you might have. And maybe Soren, you have one or two.
I do, in fact. I do. Definitely one. And the one actually relates to the scenario planning. Because you started out saying that the financial model helps you tell your story, right? And when you do that, your story can take different turns. And you call them, I think, the base case, the worst case, and the best case. You could label them otherwise. You could say, well, one is a regulatory nightmare, for instance, because it happens. We are building products and the law suddenly changes and we need to adapt it. And this means we need to adapt our model. We'll see, okay, what kind of consequences does it have and so on. Do you have any kind of guidance on how often we should update our financial models?
Yeah, very good question. I'm happy to expand on that. So on that quantitative part, how often? So what I know what corporates do kind of in this very volatile world that we are living right now. Basically, they are updating every 2-3 days. I know the startup resources, this is probably impossible. However, it also depends on kind of on your particular industry that you operate in, particular developments, whether that's geopolitics. For example, you are sourcing from geopolitically sensitive regions, so basically, yes, you have to track what is happening there and adapt your model, right? So I wouldn't say that there is kind of a number, but at least to check and look at it once per month, and maybe to also check whether it is matching the kind of your accounting, your kind of your bank statement, right? Because what do you forecast and what is in real life, it is often 2 different things, and that is okay because we cannot actually know everything and forecast every little tiny bits. But now I actually lost the first part. I forgot the first part of the question.
Okay, sorry, because that was a bit long, Marina. Sorry for that, but I'd like to just build on this one because um, what would be then the input? Let's say if we're building scenarios, one of the dimensions that we are thinking about, that's the timing, right? That's the timing of certain events. What kind of other key variables would you put into a scenario planning for your best your base case and your worst case?
Yeah. So actually, I have remembered what I wanted to say before. So that would be maybe my advice to not to build all your strategy and all the business model on some kind of one regulation that can change, right? Or even if you do so then have a backup strategy. That what do you do in case this regulation changes? Can you still sustain your business, or do you need a complete turnaround and pivot? So I think that is kind of crucial as well. And regarding the particular drivers that we should, yeah, actually, I would say this is very industry kind of specific, independent. But since we are here at Forward, so yeah, let's take examples, Soren, and let's analyze it. Let's say we are some kind of a company that is developing new next generation solar panels, right? So what will we recommend to that assumptions page? How do we build it? Let's kind of maybe brainstorm together.
So I think one easy one is a volume one, right? How much are we planning to produce over time, and what could impact that, right? The weather. The weather. Sorry, no, but also the technology, right? Because one of the startups that I am involved in actually can disrupt the current technology with what they are doing. So maybe some form of new manufacturing technology, or even new technology that would do away with the current ways of doing things.
Yeah, exactly. And for example, also the assumption, for example, you're assuming you'll sell 10,000 pieces a year, but you have only one sales representative that is working half of the FTE. So whether that is realistic. So I think the assumptions, should go both bottom up and kind of bottom up and top down. So
Okay, yeah.
to kind of a match from both sides, whether you are capable to deliver on those assumptions, how much you kind of sell. And yeah, I think I have mentioned this one before, the customer kind of conversion and adoption rates. I know this is really hard to forecast it, but kind of as you grow and as you get this feedback from the industry, you can get actually pretty close with that number to the reality. So yeah.
Thank you. And we have a very, very practical question in the chat from Kieran. And he asks, do you have advice on where to find good template financial models to adapt, especially for early climate startups? Any good resources out there?
I don't know, Soren. I am not a fan of any tools. Good old Excel spreadsheet.
Right. But I think maybe Kieran is thinking about if there is a kind of a template or a place where you could find good templates for these things. So good Excel templates or Google Sheets or something like that. But there's already, let's say, you already told us about the income statement, the balance sheet, and the cash flow statement, right? So they would be part of any financial model in this area, right? So that would be a good basis for starting out, and then you add your assumptions, of course, to it. Would there be? I mean, there are certainly places where you can find these templates. I mean, I'm building them myself, so I'm not a big user of pre-built, but I think it would be good if we could share one or two good resources with the audience.
Yeah, exactly. So from the top of my mind, I don't remember, but let me just have a quick look into my cheat sheets. um, but on the other hand, I am also not a fan of pre-build because you need to kind of still change it really much. That sometimes it's just faster to build it because you don't have like hundreds of different products and different kind of business models to have a really comprehensive. Yeah.
I think maybe you and I mean, that's relatively easy for us to say, right? Because we're used to doing these things. But maybe the audience, they have other kind of skills that are their focus skills. Maybe they aren't so much used to that. So it could be good to start off with something, so you don't start completely on a green field.
Yeah, exactly. Let me just. Can I add something into the chat?
One argument for building it yourself is, of course, then you understand how it works. Sometimes if you get a template from someone else, it takes quite some time to understand their thinking and how they have built it.
Exactly. So here are some tools. I must say I have never tried them, but someone who is tool savvy recommended me those. So yeah, I think we have several minutes left, and I hope the QR code of the LinkedIn, if you want to connect with me, will work. And
I'm
yeah,
trying it. I can try it out. Yeah, it works. And then connecting to you.
perfect.
So maybe conscious of time, if there are no other questions from you guys. Yeah, by the way, Marina and Soren are here. You can ask questions to them in other moment. This is not the only place and time in which we can connect all together. So don't worry. But I really would like to thank you both, Marina and Soren, for your precious insights on building scalable financial models for climate startups. You gave us a clear presentation about how critical it is building a strong, credible financial model, integrating fundraising into the forecast, and taking into consideration metrics that investors are interested in. So the recording of this session, with the presentation itself, will be available on Circle. So if you need something, just check it out on the event page. I'm here. If you need any other instructions, just text me on Circle platform. And of course, the Forwards consulting service is available if you are interested in a one-to-one session, to go deeper on your specific case. So just as I said, we're here. Thank you again for joining. Thank you, Marina. Thank you, Soren, again. I guess see you in the next webinar.
Yeah, thanks a lot, Chiara. And I'm just in case you could not manage to scan the QR code. So both of us are available, I think, on LinkedIn, right, Soren? You're quite active there as well. And you can reach out to us if you have specific questions. And we might be able to address them.